another way, alpha or inefficiency is a zero-sum game. If you do anything but hold the market portfolio, the only way one person can win is if another person loses. Why would you get in a zero-sum game? Oh, because I'm smarter than the average guy. Well, he thinks so too, and half of you are deluded. So alpha is a dangerous game to play. Alternative beta is a fine game to play. Understand what risks you're able to take that the market is not able to take, and that's a good reason to invest. So I think changing your mindset from alpha, skill, inefficiency versus market beta to there are many different kinds of exotic beta, which ones can I invest in, and which ones do I need a professional manager to help me invest in, I think that makes much more sense of the whole hedge fund industry and hedge fund investment problem. Let me go on to two other points. So what we've done is rather extensively talk about hedge fund returns and risks and how to think of those. Why did I spend so much time on them? Well, that's something that academic literature has something to tell you about. The other aspect of hedge funds is the fees. So a hedge fund typically takes 2% off the top and 20% of the profits. So I graphed here as a function of portfolio value how much the hedge fund gets. 2% if you have this much money now, 2% off the top if they lose, and then 2 and 20 if they gain. Okay, another quiz. Take you back to your graduate school. What is that? Answer. That's a call option, right? The manager of a hedge fund has a call option. If things go up, it does well. If things go down, he doesn't pay anything. Now, giving a hedge fund manager a call option is like giving your teenager keys to the car and a case of whiskey. It's what we call in the business an incentive for excessive volatility. Right? So you got to think hard, given that that's going to be the compensation structure, you need to think hard about what we do to mitigate this incentive for excess volatility. And there's lots of responses to this. Hedge fund managers won't say we haven't thought about it. One is the managers say, oh, we're co-investing with you. That's an interesting one because that violates every rule of portfolio theory, which is don't invest in your own company unless you have to. Our reputations will be hurt if we lose your money. That's interesting because all the LTCM partners are back in business doing something else. High watermarks, well, you know, that the high watermark idea, once they lose money, they have to make back that money before they start taking a fee. That's a good way of limiting volatility incentives. But on the other hand, we all know high watermarks don't really work because if they're below their high watermark, they'd rather close down and start a new fund rather than go back and make your money. So it's a real issue whether this works, and I don't have an answer, but if you're going to invest in hedge funds, you need to think about that aspect of the contract structure very carefully with your hedge fund manager. Or write into the contract some risk management. The volatility part is something that you can include in the contract. You want disclosure of the risk management. That may be another way to handle this. Another big problem with hedge funds is hot money and magic alpha. Liquidity, withdrawals. Now, many hedge funds, it's almost central to what hedge funds do. The typical strategy is a convergence trade. So this is overpriced, that's underpriced. So what do? We short this and we buy this, right? That's what any long-short strategy does. Of course, if you short this and you bought this, there's a good chance that happens before that happens. You can lose money on the way. Maybe, the thing I regret most is we just lived through the fixed income buying opportunity of a lifetime in 2008 when credit spreads went nuts and then they came back again. We all should have bought at the bottom. We can't buy at the bottom, but when they widened, there was a moment to buy and then suffer some losses. Now, what the problem with hedge funds is, if there's a great deal, this is overpriced, that's underpriced, we're going to sell this, we're going to buy this, it's a great deal, invest. You say, I see it, let's invest. Whoop, the spread widens. We just lose money. I call you up and I say, hey, I lost $10 billion of your money. And remember that screaming buy opportunity? It's even better now because, give me some more. Well, that's a very hard sales call, and in fact, it's a sales call that tends not to work. What tends to happen when you have a good deal that becomes a great deal is all the other investors run for the exits and force the hedge fund to cash out when the good deal became a great deal. Or they didn't do their risk management right, the spread widens and they face a collateral call that they can't make. So, that's the essential nature of hedge fund investing. Be sure you're understanding that. Be sure that your hedge fund understands things can get worse before they get better. And be sure that the other investors in the hedge fund are on with that. That's why lockups are getting less and less popular. As Steve mentioned, that's an advantage of private equity investment. The other investors in private equity can't get nervous and jump out. If I were investing in a hedge fund, I would actually want lockups. Not because I want my money locked up, because I want the rest of you guys' money locked up, and I don't want you bailing out on this thing if it becomes a good idea. Okay, the big issue. I don't have good answers, but I have good questions. The contract structure with your hedge fund matters a lot, and you got to think about how you're going to get through both of these issues. The last question is, how do you put hedge funds in a portfolio? We've talked about a hedge fund as a standalone investment, but nothing's a standalone investment. Every good investment gets made as part of a portfolio. So let's think about the special issues of portfolios. To motivate that, I have here a pie chart, which I simply grabbed off the internet. It's a public thing. This is the investments of a large university endowment. And I'll let you guess which one. And the pie, they have they have a lot of money, and it's about 10 billion overall. And notice that, like most large institutional investors, there's a private equity, there's U.S. equity, which is also actively managed, and there's absolute return, which is a promise, not a fact. And the absolute return is primarily invested in non-directional hedge funds. So this is a portfolio that has a diversified portfolio of many hedge funds along with other actively managed stuff. Well, let's think about putting hedge funds in a portfolio like that, not just as a standalone investment. So problem one with hedge funds in a portfolio is risk management. Will all your hedge funds go down together? Now, they may have promised you alpha, that we know how to pick the diversified, we know how to pick the underpriced, inefficient securities. But it's kind of interesting that all of the alphabets seem to fall apart at the same time. This is another thought that leads me towards exotic beta rather than alpha as the central story of hedge fund investment. If what hedge funds and other active managers were doing was truly finding inefficiently priced securities. You're too low, your price is too low, your price is too low, your price is too low. I buy those things. I should be putting together a portfolio of undiversified little risks. Lots of little things. The more of them I buy, the more I get alpha, and we diversify the risks. The interesting thing that seems to happen is all of these underpriced securities, I put them in a portfolio and they all fall at the same time. And George is also putting together his underpriced securities, and he puts together a portfolio of his bets, and they all fall at the same time. Mine fall. Gee, doesn't that smell like some exotic beta factor? Still might be a good idea, but it tells you that where you're getting your return, you are exposing yourself to some other portion of risk. So that's what it tells you from the hedge fund point of view. From the portfolio point of view, you got to watch the fact that your diversified hedge fund managers might all be loading up at the same time. And as you noticed, all of my different styles except short bias went down in the financial crisis. Oh, correlations increased. Maybe you guys were all secretly invested in the same thing. To answer this question, once again, you've got to understand the betas. And not just market betas, but at least a spectrum of exotic betas that you and the hedge fund can understand. The worst problem is the cost and fee explosion. So you certainly have a passive portfolio, and then you have the active portfolio, and the private equity portfolio, and the hedge fund portfolio. Now, let's think about the hedge fund portfolio, the hedge fund as part of the portfolio, not just a standalone investment. Question one, is the hedge fund short something that you already own? A typical hedge fund has a long-short portfolio. They might be a value minus growth hedge fund. Well, if you have an S&P 500 portfolio, S&P 500 investment, and then you invest in a long-short hedge fund, the long-short hedge fund is going to short sell something that you own in the passive portfolio. Suppose your portfolio is 10A and 10B. The hedge fund decides to long A and short B, because that's our great alpha trade. Well, your overall portfolio is now 11A and 9B. Was that really worth paying 2 plus 20 to the hedge fund to do? Worse, you don't put money in one hedge fund. You put money in a diversified portfolio of hedge funds, right? Well, let's think about this. In your diversified portfolio of hedge funds, it is virtually certain that hedge fund 1 is long the same thing that hedge fund 2 is shorting. Let us think what you have accomplished by that. Absolutely nothing. If fund 1 is long, what fund 2 is short, then what do you do? Actually, you've actually managed to accomplish something even better. You've managed to accomplish pouring money down a rat hole. Because one of these guys is going to go up, and one of them is going to go down. The one who gets up gets his performance fee. The one who goes down gets his management fee. You paid 10% for absolutely nothing. More deeply, there's a cost explosion. Well, some of the central fallacies of finance, one of the central fallacies, a portfolio of options is not the same as option on a portfolio. If you had 100 stocks in one fund, and they were completely offsetting, what would you pay? The 2% management fee for sure. If the 100 stocks are in 100 different funds, half of which go up and half of which go down, you pay 2% and then half of the performance fee for sure. The option character of the fee that explodes your costs as you start diversifying across portfolios. So last, those were the good thoughts about hedge fund portfolio investing. Let me suggest some bad thoughts to avoid. Hedge funds give us diversification. Wait a minute. You can't be more diversified than the market portfolio, the world market portfolio. If you have A and B, adding a long-short position does not make you more diversified. We need to add alternative investments, new asset classes. I'm sorry, if a hedge fund is an equity hedge fund, they're not a new asset classes. They're a new trading strategy in the same asset class. We need to make our rate of return targets. You can't wish returns. You can only bear risk. We hold a lot of funds to diversify across managers and therefore get back the market portfolio plus fees. If things get bad, we'll just sell on the way down and limit tail risk. This is a very common fallacy. Fallacy number 2, that a stop loss order is a put option. And hedge funds commonly do this. They say, oh, we have all these strategies. And I say, you're just writing put options. And they say, oh, no, we're not writing put options because if things go bad on the way down, we'll sell on the way down. Oh, yeah, so you've managed to synthesize a put option for free. Can't do that. Let's think about why you can't do that. If you sell on the way down, sometimes the markets jump past where you get to sell. Everybody tried to sell on the way down and limit risk in 2008. You saw how well that worked. Maybe we're understanding it the wrong way. Maybe the way to understand hedge funds is a brilliant marketing success in a marketing business. Really? They're taking generic components, putting together, branding them, and selling them. Let's think about that. What does absolute returns, market neutral, alternative asset, near arbiter, what does all this stuff mean? Well, it kind of means new and improved, right? On the box of cereal. It means high fiber, good for you. Is extraordinarily successful at separating rich people from their money. Let's give them that. 2 and 20. Let's not think of it maybe as an economic contract. Let's think of it as a marketing contract. How greedy can you be? Yeah, I'm charging 20%, but I'm only charging you money if you win. So you get to keep 80% of it. Doesn't that just seduce you into opening up your wallets? But think about what I managed to do. I managed to get you to think about framing this as a single asset, not as a portfolio, where the option character is really disastrous. The business model is the key to success. Well, on the other hand, if once you've seen this, rather than buying from the branded aisle, maybe we should be buying from the generic aisle and getting some fees. And that's, in fact, a lot of where the business is going is alternative beta in mutual fund or other low-fee products, which might be the right way to think about it. So, bottom line, there's a lot of opportunities here. There's a lot of complex products and trading strategies. I don't know how to trade momentum. If I wanted to get exposure to momentum, I would have to go to a good hedge fund who knows how to do it. That seems like a useful way to think about hedge fund investing. Lots of unanswered questions, but unanswered questions is what we call opportunities. If it was obvious how to do it, it would get you 10 basis points. So, summary of just things to remember. We talked about returns. Are they skill versus luck? and remember, it's awfully hard to tell. Remember survivor bias. You've never seen someone try to sell you a fund and tell you that he was in the bottom quartile. Remember smoothing. Remember betas. There's a lot more betas than you think, and there's a lot more alternative betas. There's a lot of option writing in the investment styles, even when they're not actually writing options. And I think stop thinking about alpha and beta and skill. Just think about what are the exotic betas that you're accessing through hedge funds. The fees, incentives, options, and contracts, those matter a lot. So think about your contracts, not just about those great returns at the end. And think about putting hedge funds in a portfolio. If you remember, one horror story of all of these is hedge fund A short what hedge fund B is long. That should open your mind to the portfolio question, and of course avoid silliness. So thank you. That's all I've got. Rex?
5 minutes for questions.
Yeah. Questions? Or did I just silence everyone? Yes, please.
Of course, the Chicago made its reputation for its seminal empirical analysis of the financial market, changing academic research and financial practice. I mean, it's a bit disappointing that, you said again, we just can't rely on the standard types of comparison analyses that we would do to really try to, look at this. Is there any type of, again, I'm not looking for a research agenda, but is there any way you can begin to think about how you approach this, again, empirically / econometrically, to try to get at some of these issues to say what kind of exotic betas is the industry exposed to? Is there alpha in certain cases that can be reliably identified?
So I guess in my excitement, I may have overstated matters. Regression analysis is great, and it's a good place to start. What I don't want you to do is just go blindly running regressions and think that that's an easy toy that stops you from thinking. So I would say that the Chicago style is we do empirical analysis, but we don't turn our brains off while we're at it. So yes, run the regressions, but don't run 1,000 hedge funds. Pick the one that came out with alpha and go put your money in that one without thinking about what they're doing. And we also, couple regressions with theory. So when you have 27 different right-hand variables in a short time span and time-varying betas, it's going to be hard. Run the regression and then sit down with the manager. If you want to figure out the beta of a portfolio, well, at least, if they won't reveal the portfolio names to you, at least give them like a risk metrics package and say, okay, reveal the betas to me. And because you can estimate betas of a portfolio from betas of the underlying assets. So that's a case where you could run regressions to understand betas of the underlying assets and then infer from that a beta of a portfolio. So I didn't want to seem totally
The problem would require more disclosure on their part, and that's precisely what they don't necessarily do.
Right, but of course you have the money, they have the disclosure, so we can negotiate on this issue. Yes, in the back.
I think you mentioned that hedge funds are illiquid and hard to value.
Some, yeah.
We buy hedge funds on a daily basis, and 90% of the securities that they own, and I'm talking 10 different strategies, are exchange traded. So they're really not hard to value. But if they are illiquid and hard to value, then comparing them to a benchmark like the S&P, I don't think it's a fair comparison. How do you compare hedge funds? What is the benchmark? If you're talking alpha and beta, you have to determine the benchmark.
Well, I think you have to talk about the hedge fund. So if the hedge fund is a fixed income hedge fund that is, it's buying, a short treasury is buying some credit spread, then I would obviously not really think too hard about benchmarking the S&P, an equity thing. Let's benchmark to sort of passive fixed income strategies. You're right about the illiquidity is specific to which kinds of hedge funds. So something that's doing, large cap dynamic trading, you would expect to be able to provide you a reasonably accurate net asset value on a monthly basis. Something that's doing much more obscure stuff that's going to be less important. The bigger issue for hedge fund illiquidity is just be aware of monthly variations in net asset value. Once you're up to certainly with things that are trading, once you're looking at 6 month to a year horizons, that's going to be less of an issue. And really worry about it if you're looking at private equity. More questions? How are we doing, Rex?
Couple more.
2 more questions. Yes, please.
Are Harvard and Yale really achieving these outsized returns? Are we just looking at it wrong, or is it because we haven't had the final chapter written?
So two answers on that. One, this is not Harvard or Yale, but it's a similar-sized university. I don't know. So I haven't dug into these portfolios, and maybe some of you guys have, and you'll be able to educate me on this. There's a lot of real estate that never trades. So they give us these quarterly numbers. We made 21.325% this quarter. Oh yeah? And that vacant lot on 55th and Kimbark is worth exactly how much this quarter? So I'm a little suspicious about that. And then there's the skill versus luck question. So I told you in the first 10 minutes you're not allowed to ask, is how X fund did so well, what about them? Well, maybe they're good, maybe they're lucky. How are we going to tell that apart? They certainly got great returns. We noticed, by the way, that many of their managers, once they leave and start their own funds, end up not doing so well. That's kind of a suspicious line. Now, maybe that's because they get information. We do know that there's a lot of information leaking around. So having access to the Harvard alumni cocktail party might be the key to their success. But it's very hard to tell skill from luck of just one fund. And one would have to, you might be able to do some work. So I noticed, we were able to see something from the Madoff feeder. Maybe if we really drilled into their portfolio, we could get somewhere. But those numbers are hard to get. One more. Yes, in back.
Have you looked into funds?
Yes, that's an interesting, because fund to funds also means fees on fees. You're paying 2 and 20 for the privilege of investing in a portfolio of options, each of which pays 2 and 20. That off the top looks kind of silly, but my thought on fund to funds is as I try to write this and synthesize it into how do we do this risk management? How do we get the disclosure? How do you do the due diligence? How do you figure out if all your funds are going in the same direction? And I think about how hard that problem is. All of a sudden, it doesn't sound so silly to pay somebody some money to do that. But the last thing, to make money in markets, you either have to know how to pick stocks. If you don't know how to pick stocks better than the average person, you have to know how to pick managers better than the average person. If you don't know how to pick managers than the average person, you have to know how to pick managers of managers better than the average person, because of course the average fund of funds isn't any good, but the good ones are good and the bad ones are bad. If you don't know how to do that, maybe you ought to just index and stop trying to chase something that you can't do. I'm going to go down.
Okay, great. Thank you very much. The 100-year steamroller analogy is interesting, and I can't think of a better city in the country that could understand this, because in 1993, as most of you know, we had the 400-year flood in St. Louis and the Midwest. And 2 years later, in 1995, we had another 400-year flood. And they quoted some geezer in northern Missouri, and he said, "Hell, I must be 800 years old." So our next speaker is Professor George Constantinides, who's a professor of economics at the University of Chicago. And in the last few years, his main effort is to study the causes of the historically observed premia of equity returns over bond returns, the value premium, the size premium, the pricing of fixed income securities, options,